Welcome back to Talk Tickers.
Good to be here.
We're the show for experienced investors, where we try to strip away all the corporate fluff.
And get right to the hard numbers.
Exactly, the numbers and the narrative that's really shifting the markets. Today, we are breaking down Charter Communications, that's CHTR.
And this call was, it was a really interesting one. It took place yesterday morning, January the 30th.
Yeah, and frankly, this is one of those prints where if you just saw the headlines...
Oh, you'd assume the stock was cratering, down 10, maybe 15%.
Absolutely. So let's just set the scene. The headline numbers, not great.
They were objectively bad, actually.
A miss on revenue, a miss on EPS, and yet the stock absolutely ripped.
Yeah, it closed up over 7.6%, sitting at $206.12.
So the whole premise for this deep dive is simple. Why on earth did the street bid this thing up?
It is a classic textbook case of less bad is good.
Right.
That, combined with a massive narrative shift around capital expenditures, the market just completely ignored the top line softness.
And focused entirely on the future.
Entirely on the future cash flow story. Investors are looking right past this sort of messy middle of 2026, and they're pricing a very different company in 2028.
Okay, so before we get to that future paradise they're promising, let's get the bad news out of the way. We need to know what the market just shrugged off.
All right, the snapshot wasn't pretty. GAAP diluted EPS came in at $10.34.
Just missed the consensus of $10.40.
Just missed. And revenue was $13.6 billion.
Which is not just a miss, it's a decline year over year.
It is a 2.3% decline. Shrinking revenue in a business like this it's never a good look.
No.
Adjusted EBITDA was down 1.2%, and free cash flow took a huge hit.
How bad was that?
It was down $211 million year over year to just $773 million.
Yeah.
So you have shrinking revenue, shrinking earnings, and shrinking cash flow.
Usually that is a recipe for a massive sell-off. A quant model would screen this as a short, no question.
For sure. But the algorithms, and I think the humans too, saw something else entirely.
Okay, so let's get to the beats. What saved them?
It all comes down to subscribers. You have to remember the context. The street has been absolutely terrified of fiber and fixed wireless access, just eating Charter's lunch.
The two-front war narrative?
Precisely.
Yeah.
Fiber on one side, T-Mobile and Verizon on the other. The fear was a massive accelerating bleed in internet customers. The whisper numbers were pricing in a complete disaster.
And the reality?
The reality was they lost 119,000 internet customers.
Which still sounds bad. I mean, losing over 100,000 customers isn't exactly a victory lap.
It is negative, yes, but in this environment, it was so much better than feared.
So the bleeding is stabilizing.
It suggests it's stabilizing, not accelerating. But the real shocker, the absolute man-bites-dog story of the quarter, was video.
I had to double-check this. In a world of cord cutting where everyone is canceling cable, Charter actually added video subs.
They did. Video customers grew by 44,000.
That's just wild.
It is incredibly rare right now. And on top of that, they added 428,000 mobile lines. A really strong print there.
So the market sees stabilization and decides the core business isn't actually imploding.
Exactly. But there's a deeper strategy here. The CEO, Chris Winfrey, used a phrase that I think just perfectly defines their whole mindset right now. He called it a game of inches.
A game of inches.
That's right. The era of easy growth is just over. He was very clear. They are not trying to grow in one silo anymore. It is all about the connectivity bundle.
This is the strategic pivot, reframing the whole business model.
It's all about convergence. And this is where that weird video growth starts to make sense.
Right, because they can't be treating video as a profit center anymore. The margins on cable TV are historically terrible.
They're awful. Programming costs just keep going up and up. So what management is doing now is framing video as a killer app.
A killer app? For what?
To reduce churn for their broadband. It's basically a loss leader, or at least a very low-margin tool to lock you into their ecosystem.
It makes sense. If I want to cancel my internet, now I also lose my TV package and my mobile discount.
Exactly. The friction to leave goes way up. They've integrated Disney Plus right into the bundle. They have this Spectrum app store.
The logic is, if you get everything on one bill, you're just not going to switch to some fiber provider who can only offer you the internet pipe.
It's the sticky bundle 2.0. But for it to work, the other parts of the bundle need to have really high margins. And that brings us to mobile.
That 428,000 number is strong, but there was a detail in the call about how they're managing that traffic.
Yes. The offload stats. This is the structural advantage they have.
So an MVNO, a mobile virtual network operator, usually just rents towers from Verizon or AT&T.
Right. And your margins are capped by what the big guys charge you. But Winfrey pointed out that nearly 90% of Spectrum mobile traffic is now being offloaded onto Charter's own Wi-Fi network.
90%. So even though they're using Verizon's network, most of the data never even touches a cell tower.
Exactly. It stays on Charter's wires. That means their cost for mobile is way, way lower than the big telcos.
Which lets them be aggressive on price. I saw that new marketing push guaranteeing to save customers $1,000 a year.
They can do that because they're essentially using their wireline advantage to subsidize a price war in wireless.
But if you're going to offload everything to Wi-Fi, that Wi-Fi has to be bulletproof.
It has to be perfect.
Which brings us to Invincible Wi-Fi. I have to admit, I usually roll my eyes at marketing names like that.
Me too. But there's real tech here, and it addresses a very specific weakness. They're launching it in February 2026. It's a Wi-Fi 7 router, so it's the latest standard.
But the key is the redundancy, right?
That's the key. It comes with a battery backup and a 5G cellular backup built right in.
Okay, so they're going right after the reliability argument from the fiber guys.
It's a direct shot. The biggest knock against cable has always been uptime during a power outage or a line cut. With this, if a backhoe cuts your cable line, the router just switches to 5G. Power goes out, the battery kicks in.
So they get fiber-like reliability without having to replace all the coax in the ground.
Exactly. But speaking of the ground, they are still doing a ton of work there. This whole network upgrade.
I-split DOCSIS 4.0.
Yeah, they're aggressively pushing for symmetrical multi-gig speeds. They confirmed 50% of their footprint will be upgraded by the end of 2026, with the whole thing done in 2027.
In symmetrical speeds, that's where your upload is as fast as your download. That's always been the big win for fiber over cable.
Right. This new architecture fixes that. But, and this is the big but, it costs an absolute fortune to do it.
Which brings us to the most important part of this whole story. The reason the stock is up almost 8%. We have to talk about the CapEx cliff.
This is it. This is the entire financial story. If you take one single thing away from this deep dive, it's this math right here. The CFO, Jessica Fisher, she basically said 2025, the year that just finished, was the absolute peak for capital expenditures. They spent about $11.7 billion.
Just a massive cash burn.
A huge burn. But then she gave the guide. For 2026, CapEx drops just a little to $11.4 billion. But the golden number, the thing that I guarantee lit up every institutional buy order, was the 2028 guidance.
Walk us through it.
Once all these network upgrades are done, they expect normalized CapEx to drop to between $7.5 and $8 billion per year.
So wait, that's a $4 billion drop in annual spending?
A $4 billion drop.
Yep.
And Fisher did the math for everyone on the call. She explicitly said this reduction by itself is equivalent to $28 per share of free cash flow.
Let's just pause on that. $28 per share of incremental FCF just from stopping the construction.
That is the entire thesis. You apply a 10x, 12x multiple to that, and you can see exactly why the stock repriced in a single day.
The market is realizing the current cash flow is artificially depressed. In 2 years, the spending stops and the spigot turns back on.
That's it. But they're also being smart about capital allocation now to bridge that gap.
Right. They bought back $760 million in shares, which is pretty standard for them, but they adjusted their leverage targets.
Down to 3.5x to 3.75x. They were comfortable up to 4x before.
What's that signal?
It's a de-risking signal. They're telling the market, we're going to preserve cash. We're not going to do anything stupid with debt while we finish this build-out. It's prudent. It calms everyone down.
Okay, let's zoom out a little. The Cox transaction, any update there?
Still just pending regulatory approval. The rationale is simple. Scale. Getting access to more households spreads out the cost of developing all this new tech.
And gives them more power when they're negotiating with Disney.
Exactly. But let's talk about that macro environment. Winfrey had some pretty aggressive things to say about the competition.
He did. He went after the fiber overbuilders, claiming they aren't even hitting their ROI targets.
Basically saying they're burning cash to steal customers and will never make money on them. A very bold claim.
And on the other side, he just dismissed fixed wireless as an inferior product.
Said it'll hit capacity limits. He's betting that as people use more and more data, fixed wireless is just going to choke.
Which is a real physics problem for wireless.
It is. And this connects to that really interesting anecdote from the call, the Silicon Valley tour.
Yeah, what was that about? Management is spending time in San Jose.
They call it the Fill the Pipe tour. They're literally meeting with developers, trying to convince them to build apps that need massive bandwidth.
Like 8K streaming, immersive VR.
Things that would just choke a normal connection. They're trying to create the demand for the network they are building.
That is 4D chess. Build the highway, then go convince Ferrari to build faster cars.
Precisely.
All right, we've covered the numbers, the strategy, the tech, and the massive cash flow story waiting in 2028. Now it's time for our favorite segment.
Okay, standard disclaimer. This is not financial advice. We are just two voices on a deep dive. Please do your own homework. This is for entertainment only.
Exactly. Please don't sue us. But if you were a hedge fund analyst pitching this to your committee right now, what's the trade? I'm calling this one the CapEx Cobra.
The CapEx Cobra. I like it. Okay, here's the setup. The market is terrible at pricing things 2 years out. Everyone is focused on the slog of 2026. The trade is to front-run the 2028 cash flow tsunami.
But you don't want to just buy the stock now, do you? It could be dead money for a year.
It could be. You're just waiting for the trucks to stop rolling.
Yeah.
So here's the structure. You sell deep out-of-the-money puts for January 2027 expiry.
Okay, so you're collecting premium, betting the stock won't crash from here. The floor is in.
Right. And you use that premium you collect to fund the purchase of January 2028 calls.
Ah, so you're financing a long-term bullish bet with the market's current indifference.
The logic is simple. You believe the CapEx cliff is real. If that CapEx drops by $4 billion, free cash flow doubles. The stock isn't trading on today's earnings. It's trading on a future cash flow yield that doesn't exist yet.
And by 2028, when that yield is real and on the balance sheet, the stock re-rates massively higher.
You get paid to wait.
Love it. But,
Yeah.
devil's advocate, what's the risk? How does this blow up?
The risk is the Invincible Wi-Fi turns out to be invisible to consumers. Or that fixed wireless steals another 2 million subs before the upgrades are done. If the subscriber bleed gets worse, the whole cash flow story breaks.
High risk, high reward. Hence the CapEx Cobra. It strikes when it finally hits.
Yep. It's a bet on the thesis holding for 24 months.
All right, let's wrap this up. Recap for everyone. Charter Q4 2025. Revenue miss, EPS miss, but a massive narrative win.
It's all about subscriber stability.
Yeah.
The roadmap. The bleeding slowed. Video is sticky. Mobile is growing.
And the market is finally seeing that light at the end of the heavy spending tunnel. The cable bundle isn't dead. It just morphed into a connectivity bundle.
The cash flow is coming. The only question is if you have the patience to wait for it.
That's it for this deep dive into Charter. Talk Tickers signing off. See you on the next print.